So, HELOCs are becoming more and more of a popular topic out in the real estate community. So, I thought I would take a couple of minutes just to break down and discuss with you home equity lines of credit, HELOC, same thing. Um, Even though the HELOCs tend to have higher rates than a standard mortgage, you would ask, why the heck are people getting HELOCs over cash out refinances? Well, the number one reason is that HELOCs let you take the cash out only on the amount of equity that you need. You don't have to borrow and pay interest on the entire value of your home, which a cash out refinance you do. Plus, a home equity line of credit you can draw on as you need it. And unlike a cash out refi, HELOCs are relatively cheap to set up. So, a home equity line often costs less than a cash out refi when it's all said and done. So you might ask yourself, is a HELOC good for you right now? Almost all home equity lines of credit come with a variable interest rate. Not all, but the majority. And many homeowners try to avoid variable rates because just of fear of uncertainty. Borrowers feel that they couldn't afford the loan if the rates climb too high. But what seems like a liability in normal times, it can actually be an advantage in other times. So when rates are high, for example, a HELOC's variable rate can be more likely to be decreased as the years pass. So, for example, if rates were to fall in 2023 and 2024 compared to the 22 levels, then the HELOC's rates would fall too. And that's just because the HELOC is actually tied to the federal funds rate and the prime rate. So that would be an advantage for you if you had that. Meanwhile, with the cash out, you're usually in a fixed rate. This would remain in place for the entire life of the loan, up to 3 decades, if the market rates, even if the market rates fell. So, it's important to remember rates could also increase even more in the coming years, and that would lead to a more expensive HELOC rate and payment. So these loans do come with some additional risk. So you may be asking yourself, where were HELOC rates going to go from here? Well, the Federal Reserve increased interest rates steadily in 2022, and the mortgage rates followed this upward trend. So, what's going to happen to 2023 and beyond? Well, no one knows for sure. But there are many economists that anticipate the Fed will start to ease on its campaign against inflation. For example, and this is just an example from the Mortgage Bankers Association projections. Don't take it too seriously because there's lots of different projections out there. They show that the Fed funds rate remaining steady in 2023, but starting to drop in 2024. So if the Fed does start lowering its interest rates, then HELOC rates would go down with it too. But that's only a projection. It's not certainty. A lot can change in those projections in a very dynamic economy. So just important note to yourself, nothing is forever. Uh, Other HELOC advantages that you want to know about is the annual percentage rates, APR, are not the only things that you want to consider when you're choosing a HELOC. The structure of the loan itself can offer more serious benefits to the homeowners. Since you're only borrowing what you need, the loan balance on a HELOC is almost always lower than the balance on a cash out refi. That means that you'll have lower monthly payments, and then your existing mortgage payment, your rate and term won't be affected by the new HELOC. So, in addition, HELOC payments are based on the amount of credit in use. In that sense, they resemble like a credit card. You don't pay interest on credit cards spending limit, you only pay on your balance. So, HELOCs work exactly the same way, except that they have significantly lower interest rates than your standard credit card, which is good. So again, contrasting this to a cash out refinance that combines all your mortgage debt into one loan, one, a cash out refinance, obviously a refi would replace your primary mortgage with a new larger loan that comes with the new rate, term, and payment amount. And a lot of people right now have rates that might be in the twos or threes. So in their right mind, they wouldn't do that and get into a 6% or so 30-year fixed, right? So now let's talk about how HELOC rates and payments are structured. So HELOCs are structured into two parts. They have a draw period and then a repayment period. So during that initial draw period, you can borrow and you can repay that HELOC as often as you want up to that credit limit. And you pay interest only on the funds that you've drawn out. So if you open a $50,000 HELOC and you borrowed only $5,000, you'd only pay interest on that $5,000. The length of the HELOC draw period can vary. Common options include 5, 10, 15, or 20 years. But when that draw period ends, the most common is 10. But when the draw period ends, the repayment period begins. And that often lasts 10 to 20 years. So during this repayment period, your HELOC effectively becomes an installment loan at that point. You can no longer draw money anymore from that credit line, and then your monthly payments are what are called fully amortized, meaning that your loan will be totally paid off at the end of that repayment period. So, just want to cover some factors as well that impact your rate for getting a home equity line of credit. HELOC rates are, like I said, tied to the prime rate, but that doesn't mean that all HELOC rates are the same. Every borrower is always offered a unique HELOC rate based on different factors. Typically it's going to be your credit score. The higher your credit, the lower your HELOC rate. Right? Your debt to income ratio. If you have fewer debts and your income is high, then you're typically going to get a better interest rate with that. Loan size. HELOCs with smaller loan limits often come with a lower interest rate as well. The property type can make a difference as well. So it could be a single family, a condo, a townhome. So depending on the type of property, that would make a difference. Also, the occupancy type. Is it a primary residence, vacation home / second home, or an investment property? It's a little bit less common to find home equity lines of credit on investment properties, but I believe there are some out there that will do that. The draw period. So HELOCs with shorter draw periods often come with lower rates. On top of this, every lender is basically setting their own rate. So, one lender could offer you a much better deal than another. Just like when you get your original home loan, you want to get a couple of quotes, at least 3, so that you can compare different rates between the creditors. So that is how the rates work. Disadvantages of a HELOC. So the biggest one is really that they have variable interest rates, which many potential borrowers would see as a downside due to the fact that they have less predictable monthly payments. Another common question is, why are HELOC rates so high? So just remember, the HELOC rates mirror overall interest rate market. So they go up when the Fed raises rates, and by contrast, a fixed loan rate keeps the same rate monthly part payment regardless of what's going on in the market. Now, a home equity line of credit compared to personal loans or credit cards tends to be much lower because it is backed and safe because it's backed by the equity of the home. Another popular question: are HELOC rates tax deductible? So interest paid on a HELOC can sometimes you have to consult your tax advisor, but generally can be deducted from your taxable income, but only if you use the borrowed money to buy property or make home improvements, and only when you're improving the home whose equity is backed by that HELOC. So that's important too. To write off the interest, you need to file a IRS 1040 Schedule A, and your total deduction should exceed the standard deduction. So, here's the next steps just to kind of conclude this whole topic of HELOCs is just remember that HELOC rates are generally higher than mortgage rates, but you only pay interest on what you're borrowing. So typically your HELOC payments are often going to be much lower than your actual mortgage payments. So there's pros and cons to all the different mortgage types. So make sure that you evaluate your options carefully and make sure you check in with the lender to find out if they can offer you a HELOC rate, what the rates look like, and how that loan is structured. Hope you all have a good